Hi, and welcome back to the Life License Qualification Program video series presented by Business Career College. My name is Jason Watt, and what I'll be working through with you today is what we call the wall of death, or more formally, the financial consequences of death. The wall of death helps us to understand one of the applications of life insurance. We'll talk about other applications of life insurance in other presentations, but today we're going to work through this idea of what happens financially on death and how can we use life insurance to help address the needs that arise on death. Now, to start off, we have this life. Life is rolling along, trundling along, barreling along, whatever you happen to have with life. And of course, at the end of life, we are going to have something that should not be a surprise to anybody in a life insurance course. This is, of course, death. We're going to hit what we will call, for our purposes here, the wall of death. Now, you'll notice that I left a little gap here between life and death. There's somebody who's been there for me throughout my lifetime. And here they are again, waiting for me, saying, Jason, we appreciate all that you've done for us, but one last time, we're going to have some dealings. Of course, at this point, I have to resolve all my matters with the tax man. It's the tax man who's been waiting for me all my life, and here they are again. So what the tax man is going to do here is look at the value of all my stuff and put me through a process here called a deemed disposition of my assets. A disposition simply means getting rid of, so here I will get rid of my assets. Now, properly, I don't have to sell my assets or whatever the case is on death, but I will be taxed as if I had gotten rid of them. So, we'll go through a process here called crystallization. That means attaching a concrete value to those assets such that they can be taxed appropriately. And in order to effect that crystallization, we're going to file what we call a terminal tax return. The nice thing about dying, this is the last time that I'll ever have to do a tax return. Okay, now what kind of property are we going to put through this process? Well, we could have a variety of different types of property. The first we'll look at is what we call the principal residence. This is the home that you own and live in. Now, your principal residence on disposition is normally not considered taxed. That's no different on death. It doesn't matter who you leave it to or sell it to. A disposition of the principal residence is normally not taxed. So we will see here that at least that portion of your property is going to be exempt from what Revenue Canada would normally do here. However, other property, such as your capital property, will be subject to taxation. And capital property is going to include a broad range of property. We'll see here things like investments and real estate. We're going to dissect this further in another video. However, for the time being, it's sufficient to know that what's going to happen with this capital property is that we will pay for it with our already taxed dollars. It will then appreciate in value. The difference between what we pay for it and the value at the time of our death is what will be taxed. Now, Revenue Canada is more than fair about this. They don't tax all of that appreciation. Instead, they apply the taxation of capital gains here, or they tax it at 50%. So any growth in value that we have to pay tax on 50% of that appreciation. For example, if we bought a rental property for $100,000, and today the person who bought the property passes away and the property is valued at $200,000, we'd have a $100,000 capital gain. Revenue Canada would then tax only half of that, $50,000. You would have $50,000 added to your income, and you would pay tax accordingly for that year. We have another class of property that we will call registered property. Registered property would include primarily investments that are held in an RRSP, or a pension. Now, the reason people put money into an RRSP or a pension initially is generally for the tax deduction that you gain as a result of that contribution. And then what's going to happen is it will grow tax deferred. What that means is on death, the money sitting in this registered account or this registered property has never been taxed. If it's never been taxed, I think we can see what's going to happen here. That Revenue Canada says, we never got our crack at that. We better make sure and fully tax those amounts. And we could have one other class of property. This would be cash or near cash. This would be things like savings accounts, money held in a GIC, bills, the like. This stuff, for the most part, will have already been taxed. You might find that you have a small amount of tax to pay in the year of your death for any interest accrued in that year. But for the most part, this stuff will have already been taxed. Now, we look at all this property and we say, okay, what happens to it on death? Well, Revenue Canada takes their crack at it. They don't touch your principal residence generally. They will tax your capital property. They'll tax your registered property. Every dollar that comes out is going to be taxed as regular income. And for the most part, probably not anything to worry about here with this cash or near cash type of asset. But what's going to happen now? On death, this entity arises, which we call the estate. And if you can imagine then, the estate is going to deal with your affairs just as if you would have dealt with them while you were alive. Now, your estate knows where to put your stuff, hopefully, because you have, at some point during your lifetime, written a will. If you fail to write a will, you're said to die intestate, and now what's going to happen is your property will be distributed according to the laws of the province in which you live. It will likely still go to your heirs and beneficiaries, but probably not in the order or with the speed that you would have hoped would have happened. Now, you might have named a number of people in your will to receive this property. You might have named, for example, a surviving spouse. You might have named some of your children or grandchildren. You might have left some money to a charity, and those are all legitimate uses of the will. You could have used the will to take care of any of those needs, and that would just be fine. What we will find is that as this property flows through this process, most provinces, Quebec being the exception, will impose an additional tax here. We call this additional tax or fee probate. As I said, in Quebec, there is no probate. In Alberta, $400 is the cap of your probate. But if you happen to live in British Columbia, you can find your property probated up to 1.5% of its value, which means you could sacrifice a significant amount in addition to the taxes that you've already paid to Revenue Canada. So we put the property through this process of probate now. Now this leads us to another point, that it's not only Revenue Canada that might have gotten some of your assets as they flowed through this process. Although we are very aware of Revenue Canada, you would find also at this time that any other creditors you might have could have accessed that value. Now, we do have an advantage if we leave property to our surviving spouse. Anything left to the surviving spouse will have the taxes deferred. That is, taxes don't have to be paid at that time. Rather, we benefit from this tax-free spousal rollover. So we do have this advantage of a tax deferral only on property left to our surviving spouse. But it does, of course, leave that property untaxed to this point. When the surviving spouse passes on, at that point, of course, Revenue Canada is going to say, you never paid your taxes on that yet, now it's time to pay those taxes. So we recognize that on death, we'd like to have this property flow through relatively untouched to these folks on the other side of the wall of death. However, that might be a challenge because we do have these taxes to pay. So one of the tools that we can use to help manage this tax burden that will arise on our death, of course, we could have a fifth class of property, life insurance. And life insurance is treated in many ways differently than the rest of this property. Notably, with our life insurance in place, any death benefit from a life insurance policy will be paid tax-free. When you pay your life insurance premiums for a life insurance policy, you use after-tax or already taxed dollars. Because it's already been taxed, at the time a life insurance death benefit has to be paid, it's going to be paid tax-free. In addition to not being taxed now, so we know it will bypass taxation, it will also bypass the claims of your creditors. That is, if you happen to owe somebody money at the time of your death, and you have a life insurance policy in place, and you name a beneficiary other than the estate, we'll talk about naming the estate as beneficiary in another session, but if you name a beneficiary other than the estate, then that amount will flow to those folks without your creditors being able to access it, which would be very attractive for you and likely for these folks who survive you. It will also bypass probate. So we don't have to worry about this little bit of tax or fee that the province that we reside in happens to assess at the time of your death. Also, we will bypass the will. Now, I'm a big fan of a will. I believe that most Canadians should have a will, and probably most Canadians don't have a will. However, the will does have some limitations. What we'll find is as the property flows through the estate and to the will, this will now is a matter of public record. What that means is that anybody on this side of the wall of death can see what's happening with my will. My life insurance, though, is treated differently, assuming that I named the beneficiaries in my life insurance policy after I wrote my will. What we will find here is property will flow all the way around these processes untouched. This can be advantageous because it means the property will flow very quickly. It won't be held up by this process of probate, nor can anybody who is on this side of the wall of death see what's happening with that death benefit. That allows me to leave whatever death benefits I want to whomever I wish to leave them to without anybody else finding out about it. This is not a matter of public record. It's a private matter between my insurer and my beneficiaries at that point. The wall of death, to review, shows us what happens with the property we own during lifetime on death and how we can use life insurance at that time to help manage this process. That is, you might have some capital gains to pay on that capital property. Great. Who has to pay the capital gains? Well, properly, my estate does. How about this? I take out a life insurance policy. I name my estate as beneficiary. I own a cottage here, an example of a piece of capital property that I might own. The cottage, while flowing through this process, is going to attract some taxes. I'd like for those taxes to be paid such that the cottage can pass on to my children, grandchildren, what have you. So what I do, I figure out approximately what the tax burden is going to be. I take out a life insurance policy in that amount. I name my estate as beneficiary, although there are some other possible approaches here, but I name my estate as beneficiary. And now what's going to happen is the cottage gets here, my life insurance death benefit arrives at the estate. Revenue Canada says, we'll take some of that life insurance death benefit. There you go, taxes paid. The cottage flows through this process and ends up over here. Another important element to recognize here is that if we do name our surviving spouse as one of the heirs for this property, anything that goes to that surviving spouse, the taxes will be deferred on. We have a very specific type of life insurance policy that we can use to manage that tax deferral. We can take out a life insurance policy called a joint and last to die life insurance policy. And with that joint and last to die life insurance policy, no death benefit will be paid until the last of our spouse or our taxpayer, our income earner, whatever we have, passes on. So it's only until the last of them is gone that that death benefit will be paid. I would suggest that you become familiar with the wall of death. This actually helps to answer somewhere between 5 and 10 exam questions that show up both on the certification exam and on the provincial exam that will follow. Thank you very much. I look forward to seeing you again for our next presentation of the LLQP video series.